and serves a nationwide network of financial professionals. Call 1-800-290-7226 or email thequest@brokersalliance.com. And remember, when you need financial guidance, call Brokers Alliance.
Well, welcome back to the Quest for Financial Freedom. I'm your host, Steve Savant. And, of course, with me today is my special guest on the Quest, Eric Palmer. And you can write Eric. You can use our email address, thequest@brokersalliance.com, or call him or me, 1-800-290-7226. That's 1-800-290-7226. We're talking about permanent insurance, and in this next segment, we're going to talk about indexed universal life. Well, we've been talking about permanent insurance for the last couple of days. We talked about whole life, guaranteed universal life, current assumption driven by the current interest rates and current pricing mortality on life insurance, because we're all trying to figure out what kind of insurance are we supposed to buy. I mean, there's so many out there. Believe you me, it's less than it used to be. There used to be more.
Right.
It's just crazy how it's gotten. But today we're talking about something that's really strange, and pretty soon we're going to do a whole show on indexing only for income. Today, of course, we're still talking about death benefit, indemnification, protection, coverage needs. Okay, we're just trying to cover the sad event. Remember, one of the things about life insurance is it covers two of life's absolutes: death and taxes. Don't have to pay taxes generally if it's done right. And since I'm going to die anyways, I might as well give my loved ones, my beneficiaries, the charity of my choice, my grandchildren, my business associate, to take care of the partnership issues. Whatever those issues are, life insurance is a great financial indemnification piece of all that you're doing in your financial planning. So you need to keep it apprised. But now we're talking about indexing. And when I think about index, honestly, I don't think about life insurance. I think of the S&P.
Mm-hmm.
I think of the NASDAQ.
Right.
I think of Russell 2000. I think of the Nikkei.
The Hang Seng.
The Hang Seng China.
Right.
Yeah, I think of the Euro 50, the FTSE, and I'm not talking about, even though it's in the spirit of Valentine's today, we're still 4 days out of Valentine's. Hopefully, you've gotten forgiveness, because it's easier to get forgiveness than it is to get permission to forget. So talk a little bit about indexing, because, I don't really have guarantees now again, or do I?
There are index products out there that do have guarantees, but when we get into indexing, what we're really talking about is an alternative way for the internal buildup of cash value to perform inside of a policy, which can affect the death benefits that are payable on these policies. So the more cash value you build, the potentially higher your death benefit can go. So we've talked all this week about term insurance and guaranteed universal life insurance, where you buy $1 million policy. Most likely it's $1 million throughout the entire period of time that you're alive. You die, $1 million goes to the beneficiary. Index universal life has a buildup of cash value, because the policy itself isn't just fixing an interest rate, it's tying its performance to one of these indices that you mentioned.
Or several at the same time.
Or several, a combination,
right.
A basket of indexes. Let's just use the most common, it's the S&P 500. So what we're doing is we're saying between now and next year, what's going to happen with the index, and that could...
I don't know.
Right? That could be greater than zero in terms of the rate of return on my policy.
What if it was not greater than zero? What if it went south?
You'll never take a negative number. So the whole point about fixed life insurance with an index option is that you can have your performance of your cash value tied to a very high potential upside swing. The caps, how much you can earn up to a certain point, the cap of the earnings are somewhere between 12 and 15% in life insurance. You can earn up to 12 to 15% a year on your cash value, where all the other products we've talked about all week are right around 3, 4, maybe 5.5% on the high end of current assumption. So the indexing gives you a better way to grow more cash in the policy. Now, if you have a lot of cash and you keep hitting these big returns, it could push that death benefit up. So you may have bought a $1 million policy, but in 10 years it could be worth $1.5 million.
I'm thinking about how people that normally would like to invest, but after the last couple of years, it's been, we're shell-shocked consumers.
Right.
And especially people at my age group of the baby boomers, we were sitting on the precipice of retirement, and now this is going to, the last couple of years of losses is a major league game changer. So I'm trying to figure out, when I hear the word, I can participate in the increase, and some of these contracts have caps that go, you said 15%, my gosh, that's so high.
Right.
But you're also saying that I would also be protected on the downside, where if the S&P, let's use that index for an example, that went negative, I would just not get anything credited to me. I wouldn't have anything taken away. I would just have it credited.
Exactly right. So
now, this is unlike variable, because variable has all this upside potential, but it also has
the
downside potential. So this is, you're giving up, I don't know, what are you giving up? I mean, because
you're giving up the potential of creating a lapsed policy sooner than you would think. And when I say lapsed, I mean basically the coverage for the premium dollars you're spending is no longer sustainable. So maybe you're putting, $10,000 a year into a policy. Especially on the variable side, if there's no performance in the cash, and in fact maybe even negative if it's like a variable universal life, that $10,000 might not cover you past 5 years anymore. So the insurance company basically cannot guarantee that you're going to have a death benefit for an X certain number of years.
Well, that's disconcerting, because generally we're buying an insurance product to protect, and if I don't have guarantees in my protection or my insurance or indemnification products, why am I doing it in the first place? And by the way, this is not negative on variable. I'm just saying you get what you get. You know?
Right.
And I'm wondering that if I have a 15%, I mean, you're saying I have a 12 to 15% cap on some of these contracts, that is a pretty good number, and it's tax-free, and I have no downside because I just won't get credited anything that year.
Right.
Now, I just want to say, as a form of full disclosure here, if you were credited nothing in your account that year, the S&P went negative, but the insurance company's willing to take the hedge position on that, and you were credited nothing, you'd still have your expenses in the policy to pay. So it isn't like you'd be getting zero. You'd be probably spending maybe 2.5%, 3%,
right.
You might go down because you still have expense loads in there. Now, some of these contracts actually carry some kind of floor where they pay what, 1% or?
Yeah, it's either 0 or something like 2 or 3%. So 3% is the high end.
It could almost cover it.
You could almost cover the cost of insurance
in the worst scenario.
Right, and what we see is when we're really looking at the guaranteed side, if we're purchasing an index universal life contract for the guaranteed portion of it, then we're going to make sure we're going to use a company that has at least a 2 or 3% minimum guaranteed rate to cover that cost of insurance every year.
This is so strange, Eric, because I remember 10 years ago when indexing came out, we will never have the kind of ceilings that we have now. Like there was it was a cap, 7-8%, that was it. Now we're talking 12-15. We were told that we could only have a 60 to 70% participation rate. Now there's some that exceed 100% participation rate.
Absolutely. There's a couple companies that are at about 120 to 140% participation, and they have a spread, so there's a fee that the company's keeping. But with that type of participation rate, you could end up with a 20+% rate of return if we had a phenomenal year with an index.
See, that blows my mind. And you measure this. We track by the way, just in case, we really track this stuff. I mean, we're looking at every index in the United States that's sitting on a universal life platform. I don't know if there's any whole life out there yet. I haven't seen any. Is there a whole life indexing?
We actually have an indexed whole life contract.
That sounds
it's
wrong.
Amazing. It actually has a premium bonus attached to it. It's a single premium or a 10-pay.
That's like life insurance heresy.
You know what? But it's a great wealth transfer vehicle. So if your money's in the stock market right now and you're nervous, you don't want all your money tied up into that risk, but you like the idea that you could get better than 3, 4, or 5%. These types of contracts are perfect for you because they give you that
long-term contracts.
They're long-term contracts, but they give you that.
You're not talking about getting in and out every other year.
Exactly, but you have that upside potential and you have that floor where you can't really take too many losses in the contract itself.
Well, think about this, ladies and gentlemen. I mean, I got to say, and producers who are listening, this broadcast, of course, as many of you know, we distribute. This broadcast goes to 250,000 producers in the United States and financial advisors. And when they listen to this show and they hear some of the things that Eric's talking about, they're usually in a little bit of shell shock. Now, when we talk about almost like caps are almost up to 15%, 140% participation on some of these contracts, you're above the line. And now we're talking about guaranteed floors of a point, maybe even up to 3 points to protect all your all the expenses in the contract.
Right.
I'm waiting for the first carrier, and this is a challenge to every carrier, and we have carriers that listen to our show. We send it to all our guys for our compliance issues. This is a challenge to our carriers. Life insurance carrier, you've heard all the changes that we've done the last decade. I'm waiting for the first carrier to give us participation of dividends in the S&P. That would be huge. Now, before we get too much into that, because that's fantasy land right now, I'm more interested now. Now you're talking about global too. It's not just S&P, Nasdaq, and Russell 2000, which we're familiar with in the United States, but now we're going global. We're into foreign domestic markets, like some of the ones we talked about. Talk a little bit about that.
You know, there's a lot of opinions out there. I tune into all the major shows, both radio and online, Bloomberg. You know, all the experts out there. There's a handful of them.
Don't
that
forget
are,
to charge for that.
We're
That's
keeping
Bloomberg.
a tally.
Charge that,
We're keeping a tally. There's a handful of experts out there that don't believe in domestic indexes right now. They think there's just not going to be any major pops. So it might be a more levelized type steady growth. So that's why we always put it out there that we have the availability of these foreign indices. You got the Hang Seng, the FTSE, the Nikkei out of Japan. You know, China's indice, the Hang Seng. I mean, we've seen what's been going on in China. Even with some interest rate heights that they've been proposing and kind of introducing slowly, we're still seeing strong performance there. So those options are available. It's about a balanced portfolio. We can use some domestic, some foreign.
On the same contract.
And the same contract.
And just real quickly, there's a couple contracts that let you participate in all three at the same time, and then whoever the winner is at the 5-year mark or the 10-year mark or whatever.
It's like betting on the horse after the race.
It's
pretty phenomenal. We call that a look-back strategy, and usually they're 1 or 3 year resets, which mean after 1 year or after 3 years, depending on the contract, we look back and we see out of the 3 indices which performed the best, which performed the middle, and which performed the worst. And in some cases, we drop the worst out of the equation. We reallocate the premiums as if you were there from the get-go.
Like what's the reallocation like?
60-40, or in some cases 50-30-20.
I thought I saw one out there. I thought there was one from a company that's foreign that was 75-25.
There's a lot of them out there.
So
there really
they
are.
toss the bad boy, and they put the major participation of your money with the one that won on this look-back strategy,
right,
which you're talking about. I mean, to me, this is phenomenal because I get some of my, especially if I have a floor guarantee, I still have my insurance guarantee, I still have my money accumulating tax-free, right, tax-deferred, I should say,
right,
and if it's done correctly, it actually could come out, we're going to talk about this tomorrow in tomorrow's show, it could come out tax-free income.
Absolutely. I mean, and so it's like the individuals that are right in the middle, including myself, where we're not sure about the domestic or the foreign. These look-back strategies let you participate in both, and at the end of the year, the insurance company will allocate based on who was better anyway. So it's kind of the best of both worlds for the investor.
Well, I want to thank you, Eric, for being our guest today, and our special sponsor always, Brokers Alliance and America, where anyone can go on a quest for financial freedom.